By the end of this course, participants will be able to understand and identify market phases, distinguishing between trending and ranging markets, and recognizing the accumulation, distribution, uptrend, and downtrend cycles. Interpret and leverage trend lines to determine market direction, spot potential entry and exit points, and enhance overall trading strategies. Recognize trend reversals and understand the significance of counter-trend movements in a trending market, enabling effective risk management and decision-making. Develop a foundational understanding of how to use technical analysis principles, such as support, resistance, and trend lines, to maximize profit opportunities and minimize risks in real-world trading scenarios. When technical analysts examine charts, the first question they often ask is, what is the market's phase? Is there a clear, definitive direction in prices either up or down, or do the charts suggest prices are moving sideways without a clear trend? Financial markets can generally be in one of two states: trending, where prices are heading upward or downward, or ranging, where there is no clear direction, and prices appear bound within certain levels. This idea can be further refined into the concepts of accumulation, a build-up and buying interest before prices move upward, resulting in an uptrend, followed by distribution, where previous buyers begin to exit the market, leading to a period of consolidation. Eventually, this can develop into a downtrend as profit-taking increases and sellers rush to exit. Support levels are price points where the asset finds it difficult to move lower, as buyers begin to enter the market, preventing further price declines. On charts, support levels are typically represented by previous lows, as prices have historically bounced upward from these points. When prices consistently rebound from a particular level, we consider it a strong support. Resistance levels are price points where the asset struggles to move higher, as sellers start to sell their positions, stopping further price increases. On charts, resistance levels are often marked by previous highs, especially when prices have repeatedly fallen from these points. When a specific price area consistently causes a pullback, it is referred to as strong resistance. Resistance levels develop when sellers begin to enter the market, preventing prices from rising any further. Chart-wise, these are represented by the highs. This is particularly true if we see prices falling back from such highs. When we note that a price area continually sees prices coming off it, we say that we have a strong resistance. There are several methods to identify potential support and resistance levels, including moving averages. Commonly used averages, such as the 50-day, 100-day, and 200-day moving averages, are frequently discussed by analysts in business news as they provide dynamic support and resistance levels. Fibonacci retracements. These levels are used to identify potential support or resistance entry points within a trend. They are based on key Fibonacci ratios, which traders use to anticipate where price corrections might occur. Pivot points. These are a popular tool for determining intraday resistance and support levels. Developed before the advent of modern charting software, pivot points remain a widely used method among traders, particularly in short-term trading. Psychological levels. These refer to major round numbers, such as 10, 100, 1000, 100,000, or 0.1000, among others. Traders often consider these levels significant because they tend to attract a high level of interest in trading activity, acting as support or resistance. In the absence of recent price action levels that are half or a quarter of a major round number, such as 50, 500, or 0.2500, may also be considered psychological levels. Each of these methods is rooted in the core concept of support and resistance, helping traders make informed decisions about potential price movements. In fact, most trading systems incorporate the principles of support and resistance as a foundation for identifying entry and exit points, managing risk, and enhancing overall trading strategies. A common trading rule is to buy at support and sell at resistance. Additionally, traders often sell when support breaks or buy when resistance breaks. This strategy leverages the natural behavior of prices around these key levels, aiming to maximize profit while managing risk effectively. After determining the market phase and identifying key price levels, the next step for a technical analyst is to ask, what is the trend? A trend refers to the general direction of the market over time. We can observe this by looking for specific patterns. In an uptrend, highs get progressively higher and lows also trend higher, while in a downtrend, highs get progressively lower and lows also decline. An uptrend occurs when buying interest is strong, overpowering the selling pressure and driving prices higher. A downtrend happens when there is significant selling interest and fewer buyers, causing prices to fall. The phrase "the trend is your friend" is a popular saying in trading, emphasizing the importance of trading in the direction of the prevailing trend to increase the likelihood of successful trades. Even when a market is trending, this does not necessarily mean there is a steady rise or sustained fall in prices. Price action often exhibits a series of swings, some of which move counter to the main trend. These are known as countertrends, and they are typically shorter in duration and smaller in magnitude compared to the primary trend. Countertrends can also present potential entry points for traders looking to jump in with the main trend. When we connect two or more significant price points on a chart, we create a trend line. Trend lines are drawn to visually emphasize the market's direction, making it easier to identify the prevailing trend. They can also help determine potential support and resistance levels, which may act as turning points for prices. Trend lines are valuable tools in technical analysis for spotting potential entry or exit opportunities. When we connect a series of higher lows, specifically, two or more significant lows where each subsequent low is higher than the previous one, we create a bullish trend line or uptrend line. Conversely, when we connect a series of lower highs, two or more significant highs where each subsequent high is lower than the one before, we establish a bearish trend line or downtrend line. In trading, the approach of a trend line often generates excitement, as it can indicate potential opportunities. Trend lines may provide favorable entry points for joining the prevailing market direction. Alternatively, if a trend line is broken, it can signal a potential exit point or a change in market dynamics. We have previously described uptrends, bullish markets, as characterized by a series of higher highs and higher lows, and downtrends, bearish markets, as having a series of lower highs and lower lows. But what happens if this pattern of higher highs and higher lows is broken? A bearish reversal occurs when, instead of forming higher highs in an uptrend, the latest high is lower than the previous high. This is often accompanied by the formation of a lower low, signaling that the uptrend may be reversing into a downtrend. On the other hand, if a pattern of lower highs and lower lows in a downtrend is broken by a higher low, followed by a higher high, this indicates a potential bullish reversal. It suggests that selling pressure may be weakening and buying interest is starting to take over. Thank you for watching. You should now have a solid grasp of how technical analysis concepts are applied to charts and how traders use these techniques in their daily activities. Be sure to take the accompanying quiz to check your understanding of the topic before moving on to the next section.